Hello, First Quantum Leader, and welcome to the second unit of understanding the elements of the balance sheet. Today we'll be looking at two specific sections of the balance sheet, being the non-current liabilities and the equity. In the last unit, you were asked to identify assets that are either current or non-current. How did you get on? Identifying the non-current assets was probably the easiest part of the task. These will be the plant and equipment at your site. Current assets are a little more difficult. These will include inventory in the warehouse that you're trying to sell, invoices sent to customers who've not yet paid, and any cash lying around the office. In the first unit, we looked at an overview of the balance sheet, and in this second unit, we'll be focusing on how the business is funded. At the end of this unit, I'm going to ask you to, this week, identify how First Quantum is funded compared with how one of your suppliers is funded. A company has two main sources of finance, debt and equity. A bit like you buying a house. You can use your savings or you can borrow money from the bank. Typically, a company like First Quantum will use a combination of the two, just as we might use debt and equity to buy a house. Debt investment comes in the form of a loan, either from a bank or another financial institution. The lender will demand a reward for lending the money, payable in the form of interest. The rate of interest is decided by the lender. They will also require repayment of the capital, that is, the amount that is lent. Equity investment comes from the shareholder. The shareholder will also require a return on their investment, which will come in the form of a dividend, which is a distribution of profit, or in the increase in value of their share. The dividend is decided by the company, the board of directors. So, any profit that a company makes can either be paid out to the shareholders in the form of a dividend or reinvested back into the company in order to grow the company and thereby make the shares worth more in the future. Because the shareholder may not receive a dividend and the value of the shares may not go up in the future, the equity investment is higher risk than the debt investment. We have to pay interest to the lender and we have to repay the capital. Thus, the equity investor will demand a higher rate of return than the debt investor to compensate them for taking on this additional amount of risk. If we look at the equity section of First Quantum, we can see that the amount the shareholders have invested is $5.6 billion. That is the share capital. And the total profit that First Quantum has made ever since it started trading, but not yet been returned to the shareholders in the form of a dividend, is $3.9 billion. There are a few other amounts in the equity section, but we don't really need to worry about them here. The total equity investment in First Quantum is $10.6 billion. The non-current liabilities section totals $11.6 billion. Most of this is the $7.4 billion of debt. There are a few other liabilities which we are including. There is also some long-term debt which has to be repaid sitting in the current liabilities section. So, very roughly, we can say that the debt funding First Quantum is $11.6 billion. So, we have equity of $10.6 billion and debt of $11.6 billion. Debt plus equity together makes the capital employed by First Quantum of $22.2 billion. This is the total amount invested in First Quantum and which the company uses to generate a return on investment. The primary concern of the debt investors, that is the lenders, is whether the company can service its debt, that is pay the interest, and whether it can repay the capital. Asset-rich companies such as First Quantum often have lots of debt, as the lenders are happy that, should First Quantum be unable to repay the amounts owed, then the lenders can take ownership of those assets and sell them. It's worth noting that First Quantum is not trying to repay its debt. Typically, it will borrow money from lender B to repay the amount to lender A. Again, this makes sense. If the company can borrow at 5% and invest at 10%, then there's no point in using surplus cash that can be used to generate a return of 10% in paying down debt that is costing 5%. What about the primary concern of the equity investors? Well, they know they may not get a dividend, and they accept that the company will only give them their investment back when, or rather if, it closes down. Therefore, the only way to realize their investment is to sell their shares to another person. For shareholders in First Quantum, this is very easy. The company is listed on the Toronto Stock Exchange, and so people are buying and selling shares in First Quantum every day. For a smaller company, unlisted like your local coffee shop, this is more difficult because the shares are not traded. So your investment in First Quantum is described as a liquid investment, meaning that it is very easy to turn your investment into cash. We will be discussing this concept of liquidity in more detail in the next section. So the non-current liabilities is equivalent to the debt that is funding the business, and the equity is the shareholders' funds that is funding the business. The debt plus the equity is the capital employed. The capital employed at First Quantum is roughly 11.6 billion of debt and 10.6 billion of equity, which is a total of $22.2 billion. So on to your task for today. Your task for this second unit is, this week, identify how First Quantum is funded compared to how one of your suppliers is funded. In the next unit, we'll be looking at what First Quantum has done with that $22 billion of capital. Looking forward to seeing you then.